It's free to sign up. You can just go to joinentre.com. You can download the app as well. It's the same thing, like I was saying earlier. So that's that. I want to start introducing our panelists and get into the event. So I'd love to have Ben kick things off, and we'll kind of go down the line. I think it's going to be good to start with, obviously who you are, your background, how you got into investing, and a little bit just about yourself, and then we can move over to Maya, Tina, and then Michael.
Thank you, Michael. Congrats on your venture here with Entre. Cool features. Excited to check it out. Thanks everyone for joining this evening, or whatever time it is where you're calling from. This hopefully will be interesting and informative, so appreciate you jumping into this event. My name is Ben Zises. I am a full-time angel investor, soon to be a fund manager. Kind of got into angel investing originally as a founder, somewhat of a failed founder, and I wear that badge with pride. So I can very much relate to many of the situations that a founder goes through. So I had a real estate, a prop tech startup many years ago, and really went through the full founder startup journey and life cycle, all the way from sort of leaving a stable job, raising several $1 million from 30, 40, 50 friends, family, seed funds, you name it. I like to say that I made every mistake that you can make, but I would say that we all know that life is just never-ending mistakes. But certainly I made a lot of them, and those mistakes, I believe, I'm almost fortunate to some extent. I'm 35 years old to have gotten them out of the way early, and hopefully help sort of not make the same mistakes twice. But my startup, after 4+ years, it was a software company similar to Zillow, but instead of searching for homes or apartments, it was searching for retail space. The concept is not so important, but as that business was coming to a close, a little bit of serendipity, I ended up at a house party. Just as a founder, I think all of us are paying attention to what's happening in the startup landscape, and my ear was just very much to the ground with the latest and greatest. And I ended up meeting a guy who knew about a toothbrush subscription company that was similar to Dollar Shave Club, in the sense of direct to consumer, beautiful design, subscription concept for an everyday, personal care item. And ended up, long story short, meeting the founders of what would become the company called Quip. And given my background and experience in fundraising and writing pitch decks and pitching investors, at the time I took a big risk. I gave them a check for $10,000, and I told them that I would love to be their first investor, help them raise their first $1 million, and ultimately turn out to be potentially bigger than Dollar Shave Club. And that experience has been tremendous, and I'm sort of living through their success because my startup could not get to a Series A round of funding, and Quip is certainly past that stage and well beyond, if you are familiar with them. And so I kind of fell into angel investing. That was in 2014, actually, when I made that first angel investment. Probably spent a few years just not making any other investments, and just sort of watching them, helping them, learning with them. And as that business started to show some incredible growth and signs of success, it gave me a confidence to make other angel investments. And so really over the last, I would say 2 or 3 years, I've ramped it up. And, listen, a lot of people like to invest in, tons of different things, stocks being one of many. And I'm sure Maya can talk about that given her background in fintech and all those things. But I love, I ended up just any money I could save, $5,000, $10,000 into startups personally. Even though now I run a syndicate, I started making investments in syndicates myself. It's a very accessible way to put small bets out there. And so, yeah, I've had just an incredible fortune of working with some amazing companies. My focus is very disciplined consumer product companies, given my niche with some of the success I've had, or with some of those companies, and then real estate, given that's been my background up until this point. So I will stop there. I've made about 15 or 20 angel investments. You can see them all on my website, superangel.vc. So that's just the brand and platform that I operate under. It's all been my own money to this point, except for some syndicates, which allows people to co-invest with me. And I'll take a break there and pass back to Mike or Maya to go on.
I thank you for sharing all that, Ben. I think it's really helpful that you went into all that detail, and I definitely want to talk about syndicates later and rolling funds, because it seems like they're all the rage now, and a lot of people are starting to roll do those. So yeah, thanks for sharing all that, and yeah, Maya, if you want to go next, that'd be great.
Sure thing. Hey guys, so I'm Maya Bittner, and my background is pretty similar to Ben's, actually, so pretty entrepreneurial. In 2012, I started a e-commerce company that was doing subscription jewelry rental. It was through that process that I got really interested in the payment side and Americans' financial health. At Rockspots, we raised about 13 million. Our seed and Series A were led by Matrix, and it's still going. So my co-founder, Meg, is running the company now. And I left to work on fintech, work on Americans' financial health, and I didn't know exactly what that would look like. Explored a couple different areas and found the biggest opportunity building a financial inclusion company called Pinch, where we reported rent payments to the credit bureaus. People could build their credit score just by paying their rent. I was really focused on product market fit because I feel like we had that at Rockspots, and I had seen how much it had done for us. So I was really focused on that at the expense of finding company with a good business model. So really, Pinch was super popular with our customers. We were not making any money. And what we ended up doing was selling Pinch to a company called Chime, which is the largest US-based venture-backed neobank, which offers like a debit card, checking account, savings account to members. So we sold Pinch to Chime in summer 2018, and then went on to build the Chime credit building credit card with what we had learned about building people's credit scores and reporting to the credit bureaus. Now I work at Chime full time, but I do a lot of investing and advising on the side. I invest in about one startup per month. And I love founders. I love talking to early stage companies, helping them work through fundraising strategy, finding product market fit, all that kind of thing. I'm very active on Twitter, which is where a lot of my deal flow comes from and a lot of the deals that I see. And I invest in a couple of different ways. So I'm a Sequoia Scout, so I invest through the Scouts program. I also write my own angel checks. Like Ben, I participate in a lot of other syndicates. And then, although unlike Ben, I don't have my own syndicate. And then I also run an angel group called Parcel BVC, which you might have seen on the invite. And Parcel B is an alumni angel group. So it's all alumni from my college, and we invest in startups that are founded by alumni from my college. So yeah, that's me. I have big focus on fintech and in making housing, education, healthcare, and transportation more accessible for Americans, whether that's making it more affordable or more accessible in any other way.
Fantastic. Glad to have you here, and thanks for sharing all that. You've had quite the impressive experience with all those companies, and Chime has been absolutely killing it. So they're definitely doing very well, and I think fintech is an interesting industry to be in right now, no doubt about it. Tina, do you want to share your background and story?
Sure. Hi, everybody. Really happy to be here. My name is Tina Eskridge. I think I'm going to break the mold a little bit because Ben and Maya have both mentioned that they started as entrepreneurs. I have never been an entrepreneur. I won't say that. I've been a budding entrepreneur with LLCs that I've opened and closed because I didn't do anything. So I admire those with the grit to go out and actually start businesses and learn from them and start again and again. My parents, both at different times in their lives, were entrepreneurs, so it's very near and dear to my heart. Professionally, I'm a marketer and supply chain professional by trade. Started my career in supply chain transitioned. My first tech role or tech company was back in probably 1997. So I fell in love with tech, kind of woven through many different industries, from financial services to consumer goods, to education. And then, finally found my way to back into tech at Microsoft, which is where I currently work today. I lead a marketing organization within the company, and right now am responsible for inclusion marketing and inclusion product strategy for our cloud program. So inclusion is very near to my heart. One of the reasons why I got involved in angel investing, I always thought that I would become an angel investor much later in life. So like Ben, I aspired to be a career angel investor full time. And I thought I would have to wait until, one, I amassed a lot more money, and two, when I was heading towards retirement of some sort, and found that wasn't true. So I started in angel investing probably about 3 to 4 years ago as a member of Pipeline Angels. If anybody's familiar with them, they are a FEM-led investment cohort that invests in FEM-led businesses and minority businesses. And that was something that I was very passionate about, both in my personal and professional life, is trying to tie those two together, because there's a lot of underrepresented individuals who get the least amount of funding when it comes to the angel investing community. And so that started my journey. I have since, invested personally in about 20 businesses to date, both individually through my own personal investment, and participating in a seed fund as well. So I'm, again, always looking for opportunities to help with businesses that are going to change kind of the way that we think, the way we look at, the way we live, making it more efficient. I'm super passionate about tying data into, new advancements in technology, and how we just live a better life, more importantly. But I invest in a lot of various different things, depending on what it is, and advise probably more businesses that I invest in, when the time permits. I enjoy, just kind of sitting with businesses, understanding, helping them to fill out their strategy, shape their vision, etc. And then kind of utilizing my professional background in supply chain or marketing to help them advance and get to, unlock the funds that they need to go forward. So that's a little bit about me.
Love it, Tina. Thank you so much. And yeah, I think you definitely had a very unique perspective coming from Microsoft and all of that. I think diversity is huge. I think we're starting to see a lot of changes to that. We're trying to help as much as we can with that. We just did a Black-led startups pitch competition a couple months ago. That was awesome. Like literally our best event to date. We had over 700 people on it, and it was amazing. So that was awesome. We want to do a lot more of those. We want to be very inclusive to entrepreneurs of all types, all backgrounds, all of that. And yeah, if there's anything that, we can do to help, like we're trying to do that. So there's probably other things that we will be able to collaborate on in the future for sure with that too. But thank you for being here, and thanks for sharing all of that. And finally, well, I guess we should say last but not least, Michael Weiser. I think I saw you in here earlier. Are you still with us?
Yeah, I'm here.
How are you? What's going on?
I'm doing great. And let me start by thanking you once again, Michael and Jimmy. These two guys are just amazing, and they're doing great things at Entre. And all of you investors should think about throwing some money their way. So anyway, so I've been involved with the Entre for a while, and I have a couple different things that sort of make me interested in this area. The first thing is that like many people on the call, I'm a serial entrepreneur. I founded 6 different businesses over the years, and none of these giant exits that, to speak of. But, when you're in that community, you have that entrepreneurial spirit. It's really hard to hold down a corporate job. The second thing is that I have been a lawyer for 30 years. I like to consider myself a venture lawyer, which means that when I work with a client, I bring my business acumen to the table, and I want to make sure that my clients are investor ready. I work on both sides of the table, so I work with a lot of investors too. But it's not just about covering your ass. It's like, how do we structure this company? How do we structure their business to be able to attract investors? How do we implement business strategies? So I'm a lawyer that thinks like a business person. But the reason why I'm a judge here is that I am the co-owner of the Westchester Angels. The Westchester Angels is an angel group located in Westchester County, New York, about an hour outside the city. And we are a angel investment group where the members make their own investment decisions. We have 25 accredited investors. We are industry agnostic, so we basically make investments in any different type of opportunity. We typically get involved in the seed round or sometimes Series A. We do syndicate with a lot of the local investment groups. In fact, my partner, Sandy, has led this initiative called the New York Area Angels Alliance, and there's about 20 groups that belong to that. So we share a lot of opportunities with each other. Personally, I've made 6 angel investments over the couple of years. One of them is doing absolutely amazing right now, and I invested when it was a $5 million valuation. They just brought in money with a $200 million valuation, and just sky is the limit, hopefully. So I am a resource on many different levels. I also happen to be a professor for entrepreneurship. So the bottom line, though, is that I love working with early stage companies and help them structure and scale the way that they should to be attractive to investors and the people that you've just heard speak before me. So by all means, I placed my information in the chat, and I always welcome conversations. So please reach out and support Entre. These guys are doing great. I can't wait till we're together again at Microsoft and we can do these things in person and eat that crappy pizza that you guys serve.
Yeah, I can't wait for that as well. Honestly, I have no idea when we're going to get back to in-person events, but hopefully sooner rather than later. And Michael, thank you again so much for being here. And I think you have such an amazing background. You've helped a lot of people, and I'm excited for this. I'm excited to see all the other things that we'll be doing together in the future as well. So thanks again for being here and a part of this again. So without further ado, I want to throw out kind of the first topic that we'll get into here, which is going to be and we definitely want to do a lot of Q&A, and I want to keep this kind of a pretty engaging discussion. So again, for everyone watching, if you have questions, please ask them in the chat, or feel free to just ask them to me directly on the chat. So the first question that I want to throw out is, what are you all have worked with amazing entrepreneurs, founders that have started and grown multi-million-dollar companies, if not in the hundreds of millions, and I think there's probably even a couple of billion-dollar companies that that you guys have invested in or worked at. So what are, if there are any characteristics of these successful founders and or the startups themselves? And this could be, probably keep it to like maybe 1 to 3 things that you've seen the founders do really, really well, and or the startups themselves they have done and executed on really, really well, that's allowed them to grow and prosper and, go from early stage or, barely off the ground to a multi-million-dollar company and help them raise money. So obviously this is more of, how can they go from the, getting an angel check to then, post angel. And I don't know, whoever wants to kick it off, we can go back over to Ben if you want to start, and then we can go down the line again if people want to just jump in.
I can jump in with 2 things from my vantage point. I welcome what the other panelists have to say. One is agility. I think it's really, really critical for any, startup owner to have agility, understand how to pivot, especially at a time like now. And I'm sure everybody has learned that lesson with the current circumstance and the pandemic. The second thing is the ability to take feedback and listen. I've worked with some founders and passed on some investments where I found the business to be extraordinary and have, a great potential. But if the founder can't listen and, be flexible, then it wouldn't be a good fit.
I'll jump in with just to sort of answer that question. So I think, Michael, just to repeat the question, it's really like what characteristic traits do we sort of see in super successful founders? And I actually thought a lot about, I've thought a lot about this, and actually a large part of my approach in some sense is finding these similar traits from founders. And so I think the first is simply unwavering ambition to build a multi-billion-dollar company. So I think, put everything else aside for a second. We are angel investors, or we are founders or venture-backed companies to achieve an outsized end result. Okay, we're not service businesses looking to have a lifestyle business, or, a few $1 million a year, a few $100,000 a year off the table. You take investors, you got to return their money, and you got to deliver, ridiculous returns, or at least the potential of ridiculous returns. And so truly just the drive and the ambition to get to a unicorn plus status is like table stakes. You can't just be sort of a passive person. You need to be willing to sacrifice so many things in your personal life in order to give yourself to your company. So that's the first, and just two others that I wrote down. I've found like relentless pursuit of perfection and product obsessed. And so those are just, it is what it is, right? It's just, it is literally impossible to create $1 billion company. It's effectively impossible, which is why so few companies actually do it. And we all read the covers and the, TechCrunch. It feels like there's so many of these companies, but the truth is there actually aren't. And actually so many of the companies that we've even read that have reached unicorn status, it's just on paper, and certainly their valuations ultimately will not get to that point when it comes to cashing out. So it's really an impossible feat, and you do need to sacrifice and have relentless passion and product obsessed. That's just something I've found, especially in consumer product companies. And I would say I don't particularly invest in too many software businesses, but I would say similar with that. You got to make sure that code is perfect and seamless, and all of that. So the third thing I would say is the ability to learn and absorb information extremely quickly. So just to repeat, unwavering ambition to actually get to that point of building $1 billion plus company, relentless pursuit of perfection, and product obsessed, making sure your product is as close to perfect as possible. And then the ability to learn and absorb information quickly, because you got to get smart as a founder on so many things super fast. And I can obviously spend time giving examples of those things in certain companies that I've seen, but I'll stop there.
Yeah, I can jump in. The one thing I really look for in founders is being really, really focused on their target customer base and on solving a painful problem for them. It's a little bit different than I think investing in like CPG companies. But I really look for founders who are like just really focused on their customers' lives. They understand everything about like what their customer is trying to achieve, what's in the way, like what they're trying to do. And that allows them to be flexible and comprehensive in building out a solution, and in a solution that actually works, not one that is sort of academically interesting. So I always really look for this like customer obsession in founders that I back.
So I'll contribute now. So one of the things that I think is really important is assessing that the leader, that the sort of founder, understands that that person can't be all things to all people. They can't be an expert at everything in their business. So it's really important to have somebody who is teachable, that's willing to listen. A lot of the investors that come to the table are strategic investors that have experience and knowledge. And when you run into a founder who seems to know it all, or at least thinks he knows it all, or creates the impression that he knows it all, or that she knows it all, it's a real turnoff to investors. So whether or not you can actually afford to build a team of successful people across all the different needs that you have, whether it's technology or marketing or finance, there are a lot of different silos that you need to occupy and show that you can be effective with. You need to be the kind of person that can put together a team and incent people to get involved, even if you don't have the capital to hire them the way that larger companies would be able to do. So being able to put together that team is something that's really important. Another thing that I would say, which is more it sort of goes along with what Maya was saying, in knowing your audience as well as knowing who your target customer is. Know who your audience is when you're looking for money. I can't tell you the number of pitches that we sit through at Westchester Angels where they spend 95% of the pitch talking about their widget and virtually no attention at all to the things that an investor wants to hear. How much they're looking for, how is the money going to be invested, what is the expected return and how quickly, what are the risks. Basically a 95% infomercial on what the widget is not going to excite me into actually cutting a check if I don't understand how I can make money. So a pitch that you do for a potential client should be a totally different pitch than what you do for an investor. Knowing who your investors are is really important. And I guess the last thing I'll say is that irrespective of how exciting any one individual is, people invest in companies. They're not, because an individual, a founder can get hit by a bus tomorrow, but is the company that behind that able to sustain and continue and be a worthwhile investment? So it's really important to have a business and not just an idea. I think that, if you're a really credible, great sort of founder who the investor can sort of trust will pivot and be able to grow and whatever, that's wonderful. But you need to basically have the person feel that they're investing in a business and not just one individual. So I think that that's a worthwhile comment as well.
If I could just jump in on that, not to, create any back and forth, but I actually would disagree with that, Michael, respectfully. I think especially at the seed stage for an angel investor, investing in the person is paramount to the company, because at the time, there certainly is no company. But also, to be honest, I think one of the biggest risks, which you very well pointed out, is the founder getting hit by a bus. And that is, truthfully, one of the biggest risks, in my opinion, to some of my early stage companies, but it's a risk that I'm willing to take. Because until a company does sort of reach that liftoff point where they have a management team and, it isn't relying on the founder's unwavering ambition to push it forward, the truth is that is a very real, valid risk. It's the hit by a bus rule. Like, no question, some of my companies, and I invest as close to day zero as possible. So first investor in Quip, first investor in Caraway, first investor, and before both of those companies were even named, first investor in a soon to be launched consumer lawn, garden, and plant care company. My risk very much is, at least in the first few years, that God forbid something happens to one of my founders, because you're right. That is a very real risk. But at that stage, there's no way to de-risk that. It's just maybe you're talking about a later stage, or you want to hear the vision for how are you going to recruit and surround yourself with other people to de-risk the key man concept of the founder's vision. But certainly I think I am very much backing the founder first versus the company or anything else. But anyway, just food for thought in case that's an alternative take appreciated.
Mike, do you want to say anything to back that up? I think I just want to give you a chance because I do think they're both extremely important. Ben is, I think, focused on, even though you're both angel investors, you can be focused on different stages of companies. So I just wanted to give you a chance if you wanted to add on.
I'm not going to disagree with what Ben was saying. I'm just saying that, a lot of the responsibility I have as the owner of a group is that we have to provide deal flow. And the investors we have tend to be a lot of gray-haired guys who don't have that sort of meet the startup person and feel that they can get the kind of vibe that Ben can from them. So I have a different context that I look at these kind of deals.
100%. Gotcha.
But I mean, I don't disagree with anything that you said. I think that it really depends on what the specific situation is.
For sure. And I think definitely at the earlier stages, especially angel round, you are making the bet on the founder because they're generally the person that's going to be putting in all the effort, the time in the earlier stages and whatnot. But I thought all this advice was fantastic. Agility, ambition to just build a huge company, product obsessed, relentless passion, perfection, learn and absorb information, customer pain point, knowing your audience, putting together a team, or just being that, that one founder too, and being relentless in your pursuit. I thought all this was fantastic. I jot down some notes because it was great stuff from everybody. I want to get into the next question here, and we had someone kind of bring this up as well in the chat. What is your generally speaking, all the people on here watching this and who are going to be listening to this later on YouTube or wherever else that we're doing this, they're looking to raise money from right now or in the near future, right? So what are the things that you guys are looking for from founders? And I know we've kind of hinted on some of this from the last thing, but this is slightly different. We can get into some like actual numbers and stuff, like how much revenue should people have to approach angel investors? What are the things that they need? Should they have a prototype, an MVP? Should they have some users? Should they have some customers? Should they have a wait list? What are some of the things that you guys want to see or that you've seen other angels want so that they can actually get that angel investment, right? So, and that could be anything from revenue to users, pre-orders, like I was saying. What are the things that you want to see from founders to make that angel investment? Whoever wants to jump in.
Yeah, I can jump in. So to echo what Ben was saying earlier is like, we're kind of in the business of backing companies that could be billion-dollar companies. And frankly, not all businesses are a good fit for a billion-dollar company. So that's one of the big things that I'm looking for. Michael, you listed a bunch of different like forms of traction in terms of wait lists or signups or revenue numbers. Traction is sort of interesting if it speaks to the depth of the problem that people are facing and how eager they are to spend money for a solution. But for me personally, I invest in a fair number of pre-launch companies that don't have any traction. And so with those, I'm really backing the founder, the space they're in, and my belief that like they have the desire and potentially the ability to create a billion-dollar business, given the market conditions and a bunch of things like that. So for me, those are the top things I'm looking at. I think it is a kind of funny dynamic. We talk a lot about, I was talking on Twitter about getting pitch feedback and getting deck feedback, and which I do a lot. And here's the thing is it's very rarely about the pitch or the deck. Like I don't really care what the deck looked like, if there's a deck, what the different categories of the deck are, what the font is, what the, right? It's like, I care about this business and like, is this a good business opportunity? And further, like, if the founder pitches something that's just like not that interesting, it's like low margins and small total addressable market and things like that, it's like, well, not only is the business not that interesting, but this is what the founder wants to build, which is fine, but it's not a good fit for me as someone who's looking to make a venture scale investment.
I agree with everything that Maya just said. One thing that I want to point out, which I think is really important for everybody to take into account, is that you might want to sort of break it down into two phases of until you get that check written for you. And the first phase is that whole pitch presentation mode, you know, getting excitement on the actual opportunity and the idea. But often overlooked is the due diligence phase. And I can't tell you the number of investments that after sitting through a great pitch from a great presenter, you know, it's almost theater. You know, you have somebody who's really enticing you and very exciting, everything sounds great. And then when you lift up the hood and you look at the due diligence, which is to evaluate the operations, to evaluate the finances, to evaluate the projections there and evaluate the legal standpoint, it's lacking. It's as if they just never really considered the fact that there's a step between, you know, baiting the hook and then reeling in the fish. So it's not a sexy thing for me to say to pay attention to this, but your likelihood of getting a check without contemplating the due diligence phase, where they're going to be talking to customers or talking to your strategic partners and evaluating what your go-to-market strategy is and all of the different things that you're sort of throwing the headline on your deck all about, you got to be able to back it up. So what we do is, you know, you see so much attrition between the initial interest and the pitch. And then, you know, when you write the check, that you really need to focus a little bit on that due diligence phase.
Yeah, I'll jump in as well. I agree with you, Michael. I think for me, you know, it's very rare that I would invest in a company that is not post-revenue. I think we are all in this to, you know, get a return on your investment, unless you're fine with giving money away, and that's great. I am not in that circumstance or in that situation, so I see post-revenue as an early indicator of the idea, the grit, the commitment to the customer, all those things kind of playing out. It doesn't guarantee anything, though. There's been companies that I've invested in that have been post-revenue that actually have failed because of strategy. But nonetheless, you know, that's what I'm looking for. The other thing is having an exit strategy, you know, making sure that you know, I know everyone, you know, every business is, you know, super important to you as an entrepreneur. However, you know, one of the things that, you know, is kind of paramount to this whole angel investing process is that in order for us to make money, the company has to exit in some shape or form. Doesn't mean it's going to be $1 billion company, but something has to happen in order for us to get that investment back. So that's really critical for me.
Anybody else want to add on that, or we can go ahead and move on?
I'll just round it out just to close the loop and give my answer as far as like what do I look for. And I think, you know, I try and learn from others. I mean, I'm very much a student of the game, so to speak. So even though these words are mine, like I've certainly I try and take best practices across all things I do. And, you know, certainly my angel investing career very much as well. And, but I certainly feel this way. So to me, it's three things that I look for. And I think a lot of, you know, it's somewhat best practice at the very early stage. So the first is team. I'll just do the first is team, the second is market, and the third is product/traction/revenue. So team being the founder, co-founders, anyone else involved, obviously at that early stage. That's the number one. Second being the market. So it has to be a category that I feel I'm uniquely qualified to assess. And as I've already mentioned on the call, for me, this is consumer products and real estate tech. I don't pretend to be an expert in, health tech or biotech or, ed tech, and all the, even fintech. I would say, I try and just stick to areas where I have a informational or educational advantage, because again, if I'm not, if I don't have some competitive advantage to choosing a company, it's just not going to be I'm not going to be great at evaluating it. And so team, then the market and category. And the third, I often do not get the luxury of even being able to assess because again, it's product traction revenue. And so my investments are often very much well before there's revenue. And so it just takes me back to step one and step two, which is back to the team and the market. And I have to go even deeper on that. And so that's kind of what I look for. But so I'll stop there.
Awesome. Yeah, I think those are all really great points. And I think, everyone has their own, investment thesis and what they look for. And I think it depends on, the company and really, if you want to invest in them, before they launch, and if they are a if they've started a company before, so that they're going to be able to have a decent launch and be able to scale fairly quickly. But I loved all of that. I think these are all great points to bring up for sure. And what I want to get into next here quickly too, before we jump into Q&A, is there's a lot of different types of, and ways that founders can raise capital, even at the earlier stages, right? So obviously the more popular route right now is safes. There's also convertible notes. I know some of you have done some syndicates, some rolling funds through AngelList. I don't know if any of you have invested in any equity crowdfunding campaigns and platforms, but I'd love to really quickly jump into those are different types, but what do you recommend for founders? Obviously every business is different. Are there any advantages that you have for founders, or what they definitely should not do maybe is the better way? Because also I've seen some founders get into some tough situations with, early investors where they, take bad terms, give up a ton of their company, and then it can kind of screw them for later rounds and later funding. So if you have any advice on what types of, terms that, people should be looking for in the angel stage, feel free to share your own terms and or what I guess you would recommend for people. And then, some of the different types of investments that you've seen at the angel stage, whether that be safe or crowdfunding or syndicate, and how those have worked out.
Okay, I'll start us off. I can contribute a couple things. The first thing that I'll say is, I know this is probably not part of the question here, but a lot of people, when they're starting their business and launching and have plans to go get investors, will listen to their accountant or listen to their lawyer and form an LLC. But you should be aware that professional investors are not going to typically invest in an LLC because of the pass-through nature of the taxation. I'm not going to go into that right now, but if you want to go and get angel groups in particular, any, perhaps an individual might, but any kind of group, whether it's an angel group or a venture capital group later on, you need to be incorporated. And in most cases, these investors want to see you incorporated in a state like Delaware, where there are a lot of protections in place for them. So that's the first thing. And then the second thing I will say is that different angel groups, and once again, I'm not talking about individual angels, but groups in particular, won't even consider a safe instrument. Safe instruments are very company friendly. It's a it's an acronym that stands for a simple agreement for future equity, but it doesn't have a lot of the protections that a convertible note might have. And because of that, like I know that my group, the Westchester Angels, as well as about 5 or 10 of the other groups that are part of our syndicate, will not even consider an investment with a safe. Safes are really great for the individual investor, the friends and family, people that you have a relationship with, but typically in front of a group. And let me temper that actually, because if you go through the safe was created by Y Combinator. And if you go through that route where you're going through an incubator and accelerator, they will use safe instruments because they have a very hands-on, close relationship with the company, more so than an independent investor. But when you start, scaling and going to these groups, angel groups and venture capital groups, your choices are taken away when it comes to the safes and the alternative things like a KISS and those other instruments that you hear sort of kicked around at early stage investments. And I'll say one last thing, which is that the appetite for those type of investments tends to be different, believe it or not, on the East Coast and the West Coast. The West Coast investors are much more favorable for doing these safe types of instruments than they are on the East Coast, which I think the mentality is a more corporate mentality, whereas the West Coast mentality is a more entrepreneurial mentality. And those are just some observations from my experience.
Anybody else want to add to that?
Just as far as like the legal structure, I mean, I definitely agree with so many.
Not necessarily the legal structure. I mean, I know you've done your own checks, right? Have those mostly been safes that you've done in your investments? And then I know you've also done syndicates. So have you recommended one thing over the other for founders, or what have you seen work well?
Yeah, well, so syndicates don't necessarily have any impact or doesn't affect the instrument of the investment, whether it's a priced round, a safe, or a convertible note. Founders generally with their attorney, and if they don't have an attorney, I definitely have some great ones I work with and recommend. But I try and be the most founder-friendly investor on a cap table, and it starts as early as the very first point of contact. And I think a lot of founders, before they even start their business, they've been advised one way or another, or they've researched one way or another, and they have some sense of what they want to do. And I'm personally totally fine in any vehicle, and I'll take the founder's lead as far as so I've invested priced rounds, convertible notes, safes. I've definitely come across folks that have certainly said, hey, we will not do anything but a price round, or as Michael was pointing out, there's 100%, there's some issues with safes relative to convertible notes, even though the intent is very much effectively to get to the same point. But I'll take the founder's lead. And then on the syndicate is just the ability to pool together oftentimes smaller amounts of capital into one vehicle, which invests in the company on the same terms as any other investor. And so the syndicate is effective. It's just an entity like an LLC that maybe has 20 investors that are in it. And that entity signs the same instrument that any direct investor signs with the company. So my syndicates are incredible ways for me to bring more capital into deals for founders. Because if I like a deal and I'll invest 10 or 25,000, I can write a deal memo, share the deck, distribute it on AngelList to hundreds or thousands of other like-minded investors that have said, hey, I like consumer products as well. And with a few clicks of a button, they can invest as little as $1,000 alongside me. And so it's really just an amazing way to just drive more capital to deals. Currently, I have an open syndicate. $275,000 comes from 60 different people currently that's very much open right now for a company that I am investing 25,000 personally into, and I'm able to bring in another 275,000 from 60 people pooled together. And from the company standpoint, they're not having to have their lawyer send a DocuSign to 60 people. Those 60 people come in as one entity on the company's cap table. They'll all vote together. They're not going to be nagging the founder for updates. They'll all effectively be managed by me. So it's just an incredible way to make angel investing accessible, but really just be able for founders to be able to raise more money. Historically, it was very difficult to do without the software and the platform that AngelList has created.
Fantastic. Yeah, I appreciate you sharing that, because I think there's some people that might still be unfamiliar with how AngelList works or how some of these syndicates work. But I think it's a great alternative for some founders, and I think it makes a lot of sense. Maya, team, do you want to add anything to that? And then we can move on.
I think everything's been covered. Oh, sorry. Go ahead.
Yeah. I think it's mostly been covered. I think it is a little bit tricky because, of course, you don't want to make a mistake with crazy startup terms, but different startups are in a position to demand different valuations and different terms. So it is tricky. My advice, honestly, is just have a lawyer review your docs and flag anything that is not typical or not standard. And then you can have a conversation with the investor who wants to include that term on why they want to include it and if they're willing to give something up to get it.
Gotcha. Okay. Fantastic. Have any of you dealt with equity crowdfunding? I don't know if any of you have actually used, a lot of these platforms or Public, WeFunder, Start Engine, Seed Invest. Have you invested on any of these platforms? And would you recommend any founders maybe doing one of those if they don't have a network, and or if they think that might be a good way for them to get a lot of investors involved, even more so than maybe a syndicate or something like that?
I haven't. I actually, just because I don't really have the experience with it, although I have looked at investments on Seed Invest just out of curiosity, but I'm not the right person to ask this question to.
Yeah, I was just curious. I'm not quite sure if anyone has any experience with those.
No.
Okay, but they're becoming more popular, which is why I wanted to throw that out there. We can go ahead and move on. So there was a question that came through on what should you look for other than money from an angel investor, right? So we're kind of flipping the, kind of turning the tables here a little bit. And obviously one of the biggest things that angels provide is the capital, right? But are there any other things that founders should look for in angel investors, right? Should they look for people who are aligned with their company and have experience in that industry or have a large network? Obviously getting, the more popular angels and, all of that can help. But, not many founders can get the likes of, some of these huge angel investors, as investors on their cap table. So what would you, what should founders look for in angel investors other than just capital?
I'll start just by saying that you identified the two other buckets, right? So one is the money, but there's a difference between what's called smart money and dumb money. And the smart money is that person who can either contribute to your company by having a industry expertise of some kind, or an expertise in a business process. So if you have a superstar marketing person who wants to invest and can open up a Rolodex, basically provide guidance on that particular discipline, that's a great get. And then the Rolodex, the connections and whatnot. I'll give a great example from Westchester Angels. So Westchester Angels, as I said, is 25 members who are all accredited investors. And if I basically could tell you with 100% certainty here that of the 25 people, I don't think a single one of them invests because they expect it to turn $1 into a $20 in 3 years. Most of them are doing it because they want to be part of something. They want to contribute to basically an exciting entrepreneurial business where they can feel that they're part of something. So they want to bring their expertise and they want to bring their connections. We have one of our members was one of the like the 5th employee at Yahoo 25 years ago, and he got paid almost entirely in stock. And he doesn't have to work a day in his life, but he will write a check to every company. He was their vice president of marketing, any company that's got a marketing platform, that has an advertising platform. So he wants to basically provide his expertise and guidance and pick up the phone and call his buddy who's the vice president at Google for marketing, right? So I think that money is obviously what you think, and that's the default number one reason to go out and get investors, but smart money brings so much more to the table. Sorry about the effect here.
It's all good. I thought that was great advice. Ben, Maya, Tina, you guys want to add anything to that?
I think it was well said. I agree with Michael 100%. You know, smart money is everything, and making sure that the angel investor is passionate about your business or just as passionate as you are is paramount to the investment, because anybody can give you $1, but it doesn't matter if they're not willing to, you know, extend themselves or extend their network, etc. So I agree with him.
Yeah, I think smart money is interesting. I think about it in a couple of different ways. One of the things that I think can be really powerful is if you have like a friend or a family member who's like, oh, let me know if you want help, you know, and they have some type of help, right? They're like, I can introduce you to engineers, or I know some supply chain guys or people in Shenzhen or whatever it is. I actually really like asking them to invest, even if it's a really small amount, into your company, because I think once they have a stake and some amount of ownership in your company, they start, they bring so much more help, right? It's like, they don't just, if they can introduce you to engineers instead of one engineer, right? They're like combing through their Rolodex, finding everyone that they could do to help you, and they can really provide a lot more help than their dollar amount of their check would really justify otherwise. So I like formalizing kind of like advisors and friends by asking them to write a check. I also think that if you have, like if your background isn't suited in your industry, that might scare away some investors. And so what you can do is you can say, look, I know I'm new. So you're new to insurance, right? You're starting an insurance company, you're new to insurance. Some investors are scared. If you get an investor who's like an insurance executive, that kind of shows it's like, look, this insurance executive is backing me, and that will often help you raise more money because you're sort of assuaging their fears by bringing in someone who has an experience that you don't have. So if there's some part of your background that is kind of missing and investors are worried about, I would like specifically look to fill that with an investor, whether that's like an early stage startup person or someone from your industry or someone from the data side, or just whatever weakness you might have in your background.
I'll jump in here. I would say first, you know, money is obviously it's a first and foremost, and it's a most important thing an angel investor in so many ways can do. Now, if you want to be an advisor or a consultant and provide some service, that's fine, but please don't go ahead and call yourself an angel investor. I think founders, you know, I just don't think it's fair. If a founder's understanding is that they're having a conversation with you because you're a capital source and you've really just sort of use the term angel investor to unfairly or sort of trick someone or lure them into you getting a business benefit out of it. I see, I think there's just maybe too many people around that do some of those things. 100%, this is not directed at anyone on this call. It's just general, something I see out there. But I also think, it's on the founder to sort of maybe do a reference check on an angel investor, because not all money is equal. Personally, I have a whole references page on my website. It's the most, something I'm most proud of, and I would direct every founder to that part of my website if they're looking for information on me. But I think not all money's equal. I think angel investors, it's just, as long as you're explicit with the founder, that's most important. There's no doubt that after cash, because that's what the companies need to get going, I think among the second most important things oftentimes that an angel can do is help with bringing, recruiting and bringing in other great team members. And of course, there's the specialties of, whether it's marketing help or assistance with supply chain, manufacturing, and things like that. But the truth is, if as an angel investor, you need to dig so far, you need to spend so much time deep in those categories, the chances are it's not going to be a fantastic angel investment for you, because that's just not how it works. You need a great founder and great full-time team. So I'll stop there, but those are some of my thoughts.
Yeah, if I could add on to what Ben was saying, I can't basically tell you the number of times that we have prospective members of our angel group, and we're able to tell right away that they're basically service providers in angel investor clothing, and we have to basically reject them, because but we bring people to our sort of member group to listen to 4 or 5 pitches from heavily screened investors, and they come up and start talking about how they're a service provider, and they're a great marketing person, and yeah, I'll write a check, but it's so transparent that they're just trying to sell their services. There's nothing that can destroy the credibility of an angel group than to bring in these kind of people that are like that. So you really do have to be wary of that. If you're a successful service provider, writing a $5,000 or $10,000 check is a great investment to get the $100,000 worth of work from the company, right? If they're talking to you at all about their services in the context of the fact that they'll be retained somehow to offer those services, then just run the other direction. That's very disingenuous and unethical, in my opinion.
I just want to comment on Scott Calick's note in the chat right there, just as far as it being a numbers game. And I would entirely agree relative to fundraising as a whole. I personally have helped companies raise tens of millions of dollars from maybe 1,000 unique different investors and institutional investors. It's a numbers game. I mean, you want to be qualified and you want to filter and you want to be organized and really try and limit the time it takes to fundraise. But it's certainly, especially at the early days, you just got to be out there relentlessly telling your story to as many people that have a few dollars in their pocket. So I would say, I would agree with Scott that it's very much a numbers game to have a successful fundraise, especially at the angel stage. Yeah,
I'm glad you brought that up, Ben, because I was actually going to get into that question next. And Scott's actually one of our angel investors, so he's a great person to know for everyone who's on as well. And he's been fantastic for us. But it was Lucas's question originally, which was, there's obviously so many funds, so many angels out there. They get so many decks. They get so many people hitting them up. How can I, as a founder in, whatever city, differentiate myself or get that intro and whatnot? A lot of investors have said that they only do warm intros. They only take introductions from their network. They only, take intros from previous founders. So if you don't have that network or those connections, what is the best way? And you can just go off of personal experience too. How do you guys want founders reaching out to you? And then maybe some of your angel investor friends too. How do they usually like to reach out to? Should they, just do a cold email, send a couple quick, bullet points and attach a deck? Should they hit you up on Twitter, LinkedIn? What are the best methods for founders to reach out to investors right now? And the other thing too is they can't go to any in-person events and, or coffee shops or things like that. So it's all a little different now with, with virtual world. So do you any, I don't know if Ben, you want to add on to what you were, saying earlier, and then, if anyone else has anything to add on that and how they want founders reaching out to them.
Yeah, definitely. Just to add to that, and just on the point of it being a numbers game, but you obviously want to try and thread the needle, and there's resources that are just exceptional. I would just tell everyone, personally, Angel List to me, I think, is really often an overlooked place. Specifically, so I actually have like a link tree that just, you can filter investors by geographic location as well as by market. And specifically, these are angel investors that have explicitly said, I am interested in deals within, fintech or B2B, media, health and wellness. It's literally angel.co/markets. Allows you to literally drill down and see specific investor individuals, their names, and see people who have, like I said, explicitly said and checked a box, they're looking for investments in this category or in this geographic location. So I think just do a little research, put together a Google sheet, target list, and treat your fundraise just like you would treat building your product, and really give it the time that it deserves. And it's an exhaustive, by the way, it's a phenomenal experience for an early founder to go through, because it's like really one of the hardest things you can possibly do. And there's no doubt that the business only starts once you've actually raised the money in so many ways. But I think it's like a good like boot camp towards what it's going to be like for the rest of your future building a startup.
I can sort of share that as part of our group, Westchester Angels, we have 6 events a year, and we present 4 companies during those events. But before that happens, we have at the top of the funnel probably about 75 companies that come to us through 3 main ways. One is that we're a participant on gust.com, that's GUST.com. And you can basically create a profile as a company and submit to investment groups. We actually look at every single company that comes to us through gust.com. And I would say that usually on average of the 15 companies that present to our screening committee, usually between 3 and 5 have come to us randomly from gust.com. So that's just total cold call type of stuff. Another third of our group comes of our sort of prospective investments comes from our relationships with all the other angel groups that we maintain. We have a monthly call where everybody talks about their most exciting investments that they're doing and the ones that we should look at, much in the way that Ben does the syndicating. And, so we syndicate on that level. So, getting that first sort of champion can lead to other champions. And then the last thing is just the networking and personal relationships that you do. The other third of the companies that come to us are because our members are very actively looking for stuff, so they present the opportunities for us. But it's all you got to put in the effort. You got to be creative. You look for people that are a member of a particular group, and then you see that they went to your same college, and then you reach out to them on LinkedIn. On LinkedIn, you see this, and get creative. And people, these angel investors, they're looking for different opportunities, and they're also people that tend to want to help other people. So, it's not going to happen just sitting in your room and hoping. You really have to put in the time and the effort. I mean, I think the famous story is that the Beatles submitted their demo tape to 150 different record labels before they finally got a deal. And in a lot of senses, this is not much easier than that would be. So you just got to put in the time and the effort.
I would add to that, as I alluded to in the top of the call, my focus has largely been, not exclusively, but largely been underrepresented minorities and FEM-led businesses. I would look for organizations like Pipeline Angels, which, I mentioned that I'm a member of, to, submit for pitches. They have transitioned to totally digital pitch summits. So we've done about 2 or 3 in the last several months. There's one coming up. So if you are a minority or FEM-led business, then please apply, because we're always looking for new companies to invest in. But otherwise, I agree with the comments that Michael and Ben have made about leveraging your networks, and a lot of it comes through those personal relationships.
I could add one more thing, which is that I've seen with a lot of the companies that I've worked with that they've received a lot of benefits from going through certain accelerator programs. Now there are a lot of accelerator programs because of the current environment we're in, that where you can go in a 2-month accelerator program entirely remotely. You pick an industry that, a lot of the accelerators are geared around a particular industry or whatnot. And, once you go through the program and the demo day with them, it opens a lot of opportunities. So you don't think that you necessarily need the sort of mentors and the guidance, but just the value of the potential introductions through an accelerator program can be very worthwhile as well.
Maya, do you want to add anything?
No, I think one of the things, well, yeah, okay, so I do. Deal flow can be, it's often works as kind of a snowball process, which is that it's really, really hard to meet any investors, in particular your first couple investors, but that once you kind of get it going, right? Like you get one investor to commit, they introduce you to like 10 more, and one of those commits, and they introduce you, and it kind of spreads and it builds. And I would always my recommendations to help with this is to focus less on, for the very early stage, focus less on raising a round specifically, and kind of as soon as you have someone who wants to commit, bring in their money, and then you can use that to help make the business more attractive to get the next person, and kind of the snowball process of raising. And I think that can make it a little bit more approachable when it's not oh my God, I have to raise all this money, but it's you just focus on getting one check at a time.
Yeah, I think this is all great advice, for sure. And I think this is one of the main things that we want to hopefully help really solve with Entre too, so that you can very easily filter and connect with investors. The problem that I've run into with AngelList and LinkedIn and some of these other platforms, is the response rate that these investors are on some of these platforms and how active they are. What I've actually found is, for whatever reason, VCs and investors love Twitter, and they are on Twitter more than any other platform out there. So I've had, a lot of success connecting with people on Twitter. We've met our investors up to this point all through our events and other events. So, that has worked out really well for us. And I think it's a great way to, I think it makes it not super transactional. It makes it, hey, we met at this event, we connected on this event, rather than just a straight cold. Any way that you can figure out how to get away from the cold outreach is, I think, the best. And finding any way to, have a similar interest or pathway, I think makes it extremely more beneficial for both people. But the other thing that I've realized, and also talking to other investors, and you guys have kind of hinted at this too, is understand your market and the investors in your market. If you're in, real estate, you should not be talking to investors in, health or biotech or whatever else. Like, understand the investors in your market and reach out to those. So like Ben's suggestion, make a list, target those people. And yeah, I think, it's definitely a numbers game for sure. But the bigger your network is, the better it's going to be. And I think with that, I want to see where we're at on time. I know we're approaching the end here. So what I want to do is thank you all so much for being a part of this. I want to be respectful of your time as well. We will do a breakout session for everyone who wants to stick around in the next 6 minutes, I think. So we'll do a breakout session for those of you that want to network, meet some of the other attendees here. We'll do some rooms so that people can meet some of the other attendees here. But for the speakers, thank you all so much for being a part of this. I want to give you all a final chance to any final piece of advice, and then where can people follow you, learn more about you, any things that you're looking for, any things that people can help you with, or any final piece of or just thoughts to wrap up.
I'll start, I guess. I guess the best way to reach out for me is to look at my LinkedIn. I posted my contact information at the very top of the chat. I'm always willing to talk and answer questions, not only about investing, but about legal as well. To me, the biggest measure of my success over the years is just relationships and just getting to know people. So I'm never too busy to have a quick conversation and just to get to know what you're all doing. My email, if anybody wants to write it down, is mjw@mwesq.com. Nice and easy. So reach out to me that way, and I'm looking forward to meeting some of you. Thank you.
Thanks so much, Mike. I'll drop your LinkedIn and email in the chat too for everybody to make it easy. Who wants to go next?
I'll go. I will just say the fact that you all are here it speaks volumes, because it says that you're committed to this process. You want to learn more. So that's you should, congratulate yourselves, give yourselves a round of applause. But I also, would say, don't give up, keep trying, fail fast, fail again, and just keep going. One of the things, we talk about different ways of getting or approaching investors. Of course, I'm sure Michael, Ben, myself, we get a lot of pitches. Like every day I get decks in my LinkedIn inbox, or people contacting me all the time. It's hard to sort through all of that. I personally don't have time to vet and do due diligence on every single wonderful idea that comes my way. So I encourage you to leverage both your networks and also some of these opportunities that we mentioned earlier. Not to say that we won't help. Don't ever give up on, you never know when someone like one of us will, say, well, this is the one that we're going to stop and look at and invest in. So don't stop doing it. But I would say, definitely leverage any and every avenue that you have available to you, because I think it's worth it. And certainly, like I said, just, I want to be mindful of those that have less advantages in the angel investing world. If you are, looking for other help, please reach out to me. Michael, I don't know if you want me to post I can post my LinkedIn.
I already dropped it in there.
You did? Okay. So LinkedIn is the best way to reach me. My email address is actually on my LinkedIn page as well at the top. So if you're looking to chat, I'd be happy to do that.
Fantastic. Thank you so much, Tina, for being part of this.
And yeah, I'm certainly best reached on Twitter, all things Twitter. And I'm chatting a lot about startups there, mostly a lot about fintech, also a lot of my personal life. So it's kind of a mix of everything. But Michael, you're correct. Spend a lot of time on Twitter, and certainly chatting with a lot of other investors on Twitter. So that's the best place to keep up with what I'm doing and get in contact with me.
Wonderful. Maya, really appreciate you being here. And I definitely one of my favorite follows on Twitter. So if you're not already following her, definitely jump on there and give her a shout. And same goes for Ben too. Ben's one of my favorite people to follow on Twitter. You guys put out great content. And I think there's a lot of interesting conversations that are being sparked on Twitter, especially with investors if you follow the right ones. So definitely give them a follow.
I'm available. Email is always best. firstname.lastname@gmail, or on Twitter. Hopefully this was helpful to everyone in the audience. Michael, congrats on Entre, and looking forward to being part of some more of these events. It was nice to chat with some of the other panelists, and definitely I try and respond to every email, even if it's just to provide a few helpful links. And so again, hopefully this was helpful, and feel free to reach out to me anytime. I appreciate just patience on my response time.
Ben, you're the man. Thank you so much. And dude, you're so fast on email. So I would be I'd be shocked if it was long at all. And for everyone who stuck around, we're gonna do kind of a special giveaway here. If you shoot us a text, I'm gonna drop the number here in our texting community. We'll give you, just let us know whatever event you want, and we'll give you a free ticket to it. We have a bunch of cool events coming up. So for everyone who stuck around, you can text us, just hi, whatever you want, and we'll get you a free ticket to any of our upcoming events. Ben is also going to be a judge at our pitch competition, which is going to be coming up towards the end of the month. So if you want to apply for that, if you want to have the chance to win $500 in cash plus a bunch of other prizes, I'm going to drop the link in here in just a second to apply for that. Or I just dropped our Eventbrite link, which you can see the pitch competition on there. And then if anyone has anything, if they need help with anything, let us know. That's what we're here for. You can email me as well, michael@joinentre.com. But to the panelists and the speakers, thank you guys so much. I'll let you guys go now if you need to. Obviously, I don't expect you guys to stick around for the networking session. So really appreciate your time and everything that you're doing for entrepreneurs and for the startup community. And, we'll be in touch. If there's anything that we can help you with, just let us know. But thank you so much. And I'm going to set up the breakout rooms now. But, the speakers, thank you. Hopefully everyone stays safe and healthy out there.